Hi, I'm Wade McElwain, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. Today is our final video before we sign off of 2020, so we thought we'd take a look at the type of trading that has seen massive growth in 2020, especially among younger traders: equity options. 2020 has seen an explosion in the number of retail investors trading the stock markets, and one leading online broker is reputed to have picked up an additional 3 million accounts in 2020 alone. Many of these new traders were not just content to just trade stocks and instead turned to a type of security known as an option. In extreme cases, some online forums promoted YOLO trades, that's you only live once, and exploiting leverage loopholes in platforms. However, the move into options trading attracted criticism from Wall Street professionals who are concerned that these traders may not be aware of the risks they're taking when trading options. So, what exactly are options and how do they work and what are the risks involved? Options are a form of derivative, which means they are an instrument whose price is derived from that of another security. In this case, those securities are individual stocks. Options that grant the right to buy are known as call options, while those that grant the right to sell are known as put options. For simplicity's sake, we'll just concern ourselves with call options from here on in. Equity options give traders the right, but not the obligation, to buy or sell a fixed amount of an underlying stock. The fixed amount is usually 100 shares. Options grant these rights at a range of different prices, rather than just the current quote of the underlying stock. The range of prices at which options are available are known as its strike price, and options are available at strikes above and below the current market quote for the stock. Options are also available in what is known as a series, with a series being the period of time that options grant their rights to their options traders. These series are typically monthly or quarterly in duration. So, for example, we might have options over a stock in a cycle that runs March, June, September, and December. However, more recent innovation has been the introduction of weekly options, and this is where the issues start to creep in as far as the Wall Street pros are concerned. You see, options are priced and valued on several factors, one of the most important of which is the length of time left in the life of the option. Options expire or die when they reach the end of their particular series. A quarterly or 3-month option has a shelf life of up to 90 days, whereas a weekly option has a lifetime of no more than 5 days. The other two factors that drive option prices are where the strike price of the option is relative to the price of the underlying stock and the degree of volatility in that security. The position of the strike price relative to the price of the underlying security determines an option's intrinsic value. For example, if you own an option that has a strike price of $10 below the current price of the stock, then that option has an intrinsic value of $10. If the strike price is $10 above the current price of the underlying equity, then the intrinsic value of the option is zero. Volatility is a measure of securities' tendency for sharp price changes that move the price moves around. The time value of options decays over the lifetime of the options, but it doesn't do so in a straight line. Instead, it falls away gently at first before plunging over a cliff as we approach the last day or expiry. This means that weekly options, which have become increasingly popular among young retail investors, have no time value, and their worth is made up entirely of the degree to which they are above or below the current price of the stock and the level of volatility within that stock. The net effect is that in buying weekly options, you have no more than 5 trading days for your bet to come right. And if it doesn't, then you're likely to lose your entire stake or investment in that option. Once you realize that around 70% of all options expire worthless or without value, you start to get an idea of the risk involved. Now, with U.S. equities pushing all-time highs, buying call options has become muscle memory for a lot of inexperienced traders. However, if conditions change sharply, the risk is that a lot of pain may lie ahead for those who don't necessarily know any better. That said, options can be a very powerful trading tool, allowing investors to leverage their returns, but the risks involved need to be thoroughly understood before taking the plunge. That's all we have time for this week. Remember, make sure you do your own due diligence before making any investment decisions.